So in this video, we're going to be having a look at the worst performing ETFs of 2020. Last video, we had a look at the best performing ETFs, so it's only fair that we do the same for the opposite. Now, once again, none of these ETFs are broad market ETFs that we're all used to, like A200, VAS or IVV or VTS, all those kind of ASX 200, 300 and the S&P 500 ETFs. They're all niche types of ETFs. Hey guys, my name is Fyzee and this channel is about finance and investing. As usual, this video is not financial advice. I'm not telling you to buy these ETFs at all. Please do some research if you are looking to invest in these ETFs. Before we get into it, I'm sure you would have all heard that the lockdown in Melbourne has been extended. South Australia has been going into lockdown as well recently, and Sydney has continued its lockdown. So the whole of Australia is basically going into lockdown, and I do hope that you guys are staying safe, staying indoors, and please do look after your mental health as well. I know this is probably one of the last things you would expect to hear from a finance channel, but it is very important. Do look after yourself. And anyways, let's get into the video. So the fifth worst performing ETF that we have on this list is ASX EEW. This is the BetaShares Euro ETF. Now, this may sound like an ETF that tracks the European economy or the European Union, but in reality, this just tracks the euro against the Australian dollar. So basically, this sort of ETF is designed for people who are looking to speculate on what's going to happen to the currency moving forward. Now, the performance for this ETF over 2020 has been minus 14.3%. So obviously it's not looking too good. And we're going to go into some of the reasons why this is the case. But before we do that, let's talk about how an investor can actually make money with an ETF like this. So to put it simply, if the euro goes up more than the value of the AUD, then this ETF will go up in value. And if you've bought the ETF, then obviously you're going to make some money. So for example, if the value of the euro goes up 10% against the value of the Australian dollar, then this ETF will also go up 10% as a very simplistic example. And this is of course excluding any fees. Now personally for me, I don't like to invest in ETFs like this at all, especially when it comes to currency, because right now I'm not too interested in the currency movements and I mostly just invest for the long term. And I have the view that if I just invest for the long term, I'll get the average kind of currency rate in between. So I'm not too worried about this sort of currency speculation too much at the moment. So the management costs for the ETF are 0.45% per year, nearly 0.5. So you're going to be paying around $45 per $10,000 invested. The distribution frequency is annual, so you're going to get paid an annual dividend. And obviously looking at the sector allocation, you can see that it's 100% euro because we're trying to speculate on the currency, so there's no surprise in this graph. Looking at the rough returns for the ETF, we can see that for the 1 year return, it's been minus 4%. And looking at the 5 year return, it's been surprisingly positive at about 4% for the 5 years. So obviously you can see the currency movements got pretty volatile during that COVID crash that we saw last year. So we can see that during that sort of crash, the ETF went up to a value of about 12% appreciation. And that's because the AUD got hit pretty hard during the period. The Australian dollar was devalued quite a lot as opposed to the euro currency. So this ETF saw a massive upwards movement. However, the Australian dollar recovered quite well after that COVID crash. So we can see that afterwards, this ETF has fallen about 15%. So it's not looking too good at the moment. And we can see a similar sort of pattern if you compare the USD to the AUD. So if you're someone who likes to speculate on what the currency is going to do in the future, this ETF may be worth looking at, but just keep in mind that there are so many factors that affect the currency. So it is sometimes very, very hard to predict. Looking at the fourth ETF on this list, we have ASX PM Gold. Now, as the name probably suggests, this is a gold-based ETF, which is Perth Mint Gold. Now, the special thing about this ETF is that investors can essentially buy government-backed gold because the government basically owns the Perth Mint. So what does that mean? So basically what it means is that if you were to buy this ETF, you can essentially exchange your ETF for actual physical gold, which I thought was pretty interesting. I thought that you wouldn't be able to do this at all, but seeing that it says that on the website, it was actually pretty intriguing. Now, personally for me, I don't really invest too much into gold because I'll be very honest, I don't quite understand the value of gold and I'm not too interested in the whole gold side of things either. But if you're watching this video and you invest into gold, let me know what your reason is or why you invest into gold in the first place. Do you believe that it is a good store of value for the future? Do you want to invest in it because it's a hedge against inflation, or do you think that it is uncorrelated with other assets in the market? Let me know because I'm quite interested to know what your thought process is about this. So based on the returns, as we can see, the 1 year performance has been minus 15.4%, so it's not looking too good. The 5 year performance though has been 6.58% per year, and the 10 year has been 4.75%. But the return since inception has been 7.9%, 7.95% per annum. Now, that was actually more shocking than I imagined. I was quite surprised when I researched this because I thought that gold would have gone up by maybe 2%, 3% per year, but seeing a return of 8% since inception, that's a pretty crazy return to me. And to give you guys a bit of a rough idea, this ETF has been running since just over 10 years, so the return since inception is actually pretty good. Now the fees for the ETF are 0.15% per year, which is actually pretty competitive. I thought it would be a bit more than that because gold is essentially physical products, so I thought it would be a bit more, but that's pretty interesting. And this fee is actually one of the lowest fees when it comes to gold ETFs worldwide, so if you are looking to invest in gold, this one may be worth looking at. Looking at the third worst ETF on this list, we have once again ASX Gold, and you guessed it, this tracks gold. Now this ETF had a pretty similar performance to the last ETF that we had a look at, and the ETF went down by 15.9% over 2020, and again it basically offers you exposure to the gold market with the benefit of not having to buy actual physical gold and holding onto it, and basically keeping the risk of having physical gold in your house. The management fees are 0.4%, which means that you'll be paying around $40 per $10,000 to hold this ETF. Now, an interesting thing that I found when I was researching this ETF is the fact that when you invest in the ETF, the underlying gold is stored very securely in the vaults of JP Morgan Chase, the bank in London. So as you guys can see in the picture, apparently this is the only picture that we really have of this vault, and this is basically an underground vault, and there's no actual images that exist of the vault in the public domain, and you can probably imagine why that's the case, for security purposes of course. And you know how we see in movies where banks have millions and millions of dollars worth of gold stored in their super secure vaults? Well, this is one of those vaults. So what JP Morgan Chase is doing is that they're essentially acting as the custodian, and they're holding gold for us on our behalf as the custodian. Now, one interesting thing that I found was that ETF Securities mentions on their website that each physical bar is segregated, individually identified, and allocated, which means that there is no credit risk, right? You heard that right, there is no credit risk. Investors can choose to redeem units for the physical holdings as well. So I thought this was pretty interesting because they're essentially claiming to have zero credit risk, meaning that this vault is so secure that there is zero risk, which to me seems like a bit of a risky statement, because if something is physical, it can still be, stolen. It's very, very unlikely. There's a 0.0001% chance of it actually happening, but it can still happen. So I thought that was a pretty interesting statement. And similar to the last ETF that we had a look at, redeeming your ETF units for physical gold seems to be a common feature for these gold-based ETFs. And once again, looking at the returns for the ETF, the 5-year return is 6.42% per year, but the inception return is 8% a year, which again is pretty surprising, and it seems to be in line with the previous ETF that we had a look at. And looking at the performance chart for the ETF and the actual benchmark, we can see something interesting, and that's the fact that during the GFC, we saw a bit of spike in the graph right here, where people started to invest more and more into gold, which kind of shows you the power of gold, and it shows how uncorrelated it is with other assets. So if you are looking to invest in something like this, check out this ETF as well. Now, the second worst ETF on this list is ASX USD, and guys, you guessed it again, this is basically a US dollar based ETF that basically compares the movements of the US dollar against the AUD. Now, this has fallen 15.9% in 2020, and due to the Aussie dollar appreciating quite a lot after March 2020, you guys can see why the ETF has gone down in value. And based on the price graph for this ETF, you can really see this happening during that March period once again. We can see that the ETF went up quite a bit during that period, and there was a gain of roughly about 20% because the Aussie dollar got smashed very, very hard. But then afterwards, the Aussie dollar has recovered so much to the fact that the ETF has gone down so much in value, it's fallen about 25%. So if in the long run you expect the US dollar to dominate against the Australian dollar, and you expect the Australian dollar to weaken over time, this ETF may be worth looking at. I'm not telling you to invest in it, this is just a general chat. But once again, things like currency are so hard to predict. They go up and down over time, and there are so many factors that once again influence currency, like interest rates, inflation, the economy, imports, exports, tourism, foreign relations, domestic relations, and so many other things. So for me, it is just way too hard to predict, and I don't really worry too much about this sort of stuff. But if you do, let me know what your thesis and what your rationale is for doing so, because I'd love to learn it. The management fees are 0.45% a year, and they pay an annual distribution. And just having a look at the sector allocation as compared to obviously the Euro ETF, this one has 100% in US dollars as well. No surprises there. Now, the last and final ETF and the worst performing ETF for 2020 that we're going to have a look at is ASX Bear. So guys, if you didn't guess it already, this is the bear market ETF, which means that this ETF shines very heavily and does very well once the market is crashing and the market is falling. So this basically behaves opposite to the ASX 200 index. So as we'll have a look at with the price graph, you'll see that during that March 2020 crash, this ETF actually went up in value quite a bit. And this is actually one of the ways where you can profit from a recession or a bear market or a bit of a correction if you time it right. But once again, this is just for short-term plays. It is not for a long-term kind of investment, because as we all know, in the long term, the market does tend to trend upwards. And as we know what happened last year with the March crash, literally like 6 months after that, the market was hitting an all-time high, which is literally insane. I don't think anyone could have actually predicted that, and because of that, the ETF is essentially at its all-time lows right now. And if we look at kind of like the max return for the ETF, you can see that it's basically fallen in value by about minus 62%. So over the long run, you can see that as the market goes up, this ETF falls in value. And over the course of 2020, the ETF fell by about minus 30%. So you can definitely see why this is the case. And during that March crash, the ETF went up by 40% during that time in literally just a month, which is not bad at all. But subsequently, very quickly afterwards, we can see that the ETF basically returned back to its previous value in just about say 6 months, and then it never went up again. Now, another reason why you don't want to hold this ETF for the long term is the fact that the management fees are literally going to kill you, right? Management fees are 1.38% per year, which essentially means that you're going to be paying around $138 per year for a $10,000 investment just to hold this ETF, which probably is not the best idea. And looking at the returns for the ETF, if we actually compare the fund returns to the ASX 200 returns, we can see that it's almost exactly opposite or thereabouts, right? So for the 1 month, it's been minus 2.36, but for the ASX 200 index, it's been plus 2.26, and the numbers kind of match up for every time period. And this basically tells us how well the ETF managers are managing this ETF when it comes to making the opposite effect happen. And the last thing we're going to have a look at is the chart, and I think this just explains it very, very well. We can see that the orange is the actual ETF and the black is the index, and this is pretty much the opposite, right? We can see that during the crashes, the opposite effect happens, and they're basically a mirror version of each other. So these were the worst performing ETFs of 2020. I personally didn't buy into any of these, but let me know if you did. If you're interested in having a look at the best performing ETFs of 2020, check out this video. And this video talks about the leverage ETFs, where if the market goes up by 1%, these ETFs increase or decrease by 3%, which basically means that they're leveraged 3 times. Check this video out. This will talk about some of the risks and some things that you need to watch out for. And guys, thank you so much for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Now, the second worst